Are you wanting to buy a house but waiting for the prices to come down, rates to come down, or the housing market to just crash altogether? These are the top 3 questions that I get when ultimately trying to decide if now's a good time for you to purchase your next home, your first home, or an investment property. So today, I'm going to walk you guys through some data in hopes of shedding a different light other than what you hear on the news and what you hear from kind of the other media, if you will. And now you might just be saying, dude, you're an agent, also an investor. It behooves you if I go out there and buy. But guys, look, I'm just sharing the data with you. Ultimately, it's up to you to make your own decision. You may watch all this and say, nope, that's still too speculative for me. And if that's what you land on, that's what you land on. But I just want you to be empowered to make the right decision for you and your family. So with that, guys, let's go ahead and jump in. And before I do, I just want to do a quick shout out to Kris Brown and Ryan Kiefer, 2 awesome dudes from FCM Mortgage. We'll talk a little bit more about them here in a minute, and I'll share their contact info down in the description below. But guys, they share a lot of this data with me. They're my go-to mortgage broker for most of my clients and some of my investment properties as well. But let's go ahead and start by first looking at some data in hopes of answering the question or the dilemma of waiting for prices to come down or potentially waiting for the market to crash. So if we go ahead and take a look at this chart here, it shows the home price index, the Case-Shiller home price index back to 1942 up to 2022. And one thing I do want to call out on this chart before you guys start sending your hate mail is this chart is inflation adjusted. If you're anything like me, you went right to 2008 and said, whoa, my market dropped a lot more than 12% in 2008. But guys, this is inflation adjusted. If we look at this, you'll see here the green years are when we got positive year-over-year growth on the home price index going back to 1942 to current state. So your first thing that you might be looking at here is, man, that's an awful lot of green. And especially going back to some of these early days back in the 40s, you're looking at double-digit growth year over year for several consecutive years. And ultimately, what this chart should show you is that a big decline in the housing market is somewhat of an anomaly. I know most of you, if you're anything like me, you grew up or you got into the housing market in the last 10 to 15 years. And so we have a recency bias of this recent 2008 crash. And so we think that this is a normal thing that just happens every couple of years and that we're going to sit on the sidelines and wait for the next one so we can jump in and grab homes up at the bottom. But guys, as you can see here, this doesn't happen very often. And when a recession does hit, it's also very unique that the real estate market is hit so hard. So we'll talk more about that in just a minute. But guys, so ultimately what this chart is saying, betting against the champ if you're betting for prices to come down. So over all those years, if we're looking at wins, the home value increase is 73, 7, and 1. So another big thing I hear is, man, homes have gone up for the last 4 or 5 years. They have to be going down, right? What goes up has to come down. But as you can see, I won't go back to the 40s, but let's even jump into the 70s, right? You know, you got 8%, 15, 16, 14. So if you're in that scenario, you got to be thinking, gosh, houses can't continue to keep climbing like this. They have to be coming down. Well, if you'd have said that in 1979, you're going to be waiting for 1, 2, 3, 4, 5, 6, almost 15 something years before you see a 1% decrease in price, a year of flat increase or no increase. And then here we go on another run again, all the way up from 1992 all the way to 2006. So hopefully what you get from that is, guys, just because we encountered this massive crash in the last 10 to 15 years doesn't mean that, hey, we're on any trajectory to do the same thing anytime soon. So take a look. You can dig more into this chart if you will. You can Google it and find it if you want to jump in for yourself too. But hopefully it's pretty clear of what the housing market typically does on an inflation adjusted basis. And if you are waiting for the next crash, who knows when that next one's going to be. Guys, here's some just other things and just show you like the news and other media inputs love to scare you, and that probably is not news to you at this point, but just to show you, what are all these big names in the real estate industry predicting versus what the current forecasts and current actuals are. So you see just about all of them are in the red except for CoreLogic, who is much more data-driven approach to coming up with their outcomes, but all of them were grossly underestimating what the current market does. So as we can see, guys, things are still going up in just about every market. Now, if you are on the coast, you will see a slightly more drastic, more volatile housing market than what we see more in the Midwest. So keep that in mind. Every market is different. I am generally speaking about the broader U.S. real estate market. Here's another thing. This goes more of answering the question of you're waiting for rates to come down before you go ahead and jump in and buy. So as you can see here, the title, mortgage rates follow behind inflation. So you'll see the inflation curve in blue there, and just about everywhere, back in the 70s, inflation spiked, and then we saw rates start to come up to accommodate that. Same thing in the 80s, inflation spiked up, so did mortgage rates, but then when inflation falls, shortly thereafter, rates come to follow. But guys, if we fast forward to 2022-23, what did we see? We saw inflation spike throughout 2020 and 21 through 23, and mortgage rates have just gone up over the past year very significantly, as most of you are aware. But guys, what do we see here on the inflation curve to follow? Due to these mortgage rate hikes, we've put a damper on inflation, and things are falling pretty drastically to the downside. So what will we expect for history to do if we're just following these simple patterns here between inflation and mortgage interest rates? Guys, it looks like all signs are pointing to rates to start to come down early to mid next year, 2024. So be on the lookout for those. And now's not a bad time to go ahead and jump in and start looking. At a bare minimum, you should always be looking at the market, keeping a pulse on your market, what things are going for. In case you find that opportunity, you are able to jump on it. So how do rates compare with the overall market in general? So one thing you have to understand, if you didn't take an economics class in any type of school, is the housing market's no different than any other market. It relies on factors of supply and demand. High supply, low demand, and vice versa. When there's a high demand, that typically leads to a low supply. When there's a low supply, the price is going to shoot up. And that's what we saw over the past couple of years of the real estate run up. When the interest rates went way down, we had a huge demand come into the market and scoop up all the inventory, which decreased the supply, and it just kind of works on itself and continues down that cycle. What I want you to take away from this chart here is that as the interest rates increase, the number of overall households that can afford a home gets priced out of the market. So it ultimately removes the demand available on the housing market. So basically, what the last two charts should be telling you is that at these higher interest rates, we almost wiped out all of your competition in the housing market. Not all of it, but we've drastically reduced that. So now you have a much more competitive advantage to go out and bid on these homes, get a price under contract before we see rates go back down, and when we would expect all of those people to flood back into the market, scooping up these houses so fast that you have to start going back over asking again and creating another increase in the housing market. So getting in at a good price today when you may not get the best interest rate, but ultimately coming back to get that later. And this chart here shows just a quick example is if you went out and bought a home now at the current values and the current rates versus waiting a year from now for rates to drop, but potentially having the values go back up because of those people coming in to shoot that up. What does that do to your overall interest rate? So if we look at this first column here, obviously that's the standard, so that's not going to adjust there. But if we look at if we wait a year for rates to drop, our home payment's going to go up by $138 per month. But now the third scenario, the third column there is what if you go out and buy today at the current interest rates, but you get a fair deal on the price. But then a year from now, you go ahead and refinance, taking the original value, you got a good deal on it a year ago, but now you refinance, lower that interest rate. Ultimately, it drops your payment by $318. So really, when rates come down, they give you an opportunity to adjust your payment. But once you sign on the dotted line for your home and you sign for that loan, you can never adjust that number unless you're just going to pay it down. But you get the opportunity to adjust and play around with the rate to get the goal you want, but you can't really adjust the price. So the whole point of this is take advantage of the price today, and you have the next 30 years to adjust the rate if you desire, and if the rates do come down like we're projecting them to do. One downside of the buy and then refinance later is you're ultimately paying double closing costs on both sides, the buy side and the refinance side. But a quick plug for FCM, if you do buy with them and then refinance within 18 months, they do waive all those closing costs on the Refinance, which is a incredible product and a big reason why I always go their way. So give them a call if you want to check that out and learn more about that product. But guys, there's pretty much no risk if you're doing that, if you don't have to pay those closing costs twice. All right, so we talked about home values coming down, interest rates coming down. Now let's dig into the folks out there who are waiting for the market to crash again. So as you can see on this chart here is a comparison over time of the total homeowner's equity against the mortgage debt outstanding. So really that's just a good quick representation, but we start to look at this chart and we look back at 2008 compared to now. So as you can see here, right at 20%, and currently we are right under 60%. So big differences in where the macro equity position is held in the United States, and we're in a much better position now, shielding us or hedging against that situation where we do get a giant decrease in home value. So back in 2008, if we lost 20% and the average equity position was 20%, as you know, we're pretty much flat, and the folks who weren't average are underwater, which was a big reason why most people weren't really in a great position to refinance or have many other options. But guys, the big reason why, and most financial educators will agree on this point, that the reason for the 2008 crash was due to subprime lending, which basically means these lenders were giving loans to people who could not afford them. They didn't go out and do their due diligence. Anyone who could fog up a mirror, aka had a heartbeat when they touched their neck, would qualify for a loan, and they got into way more of a loan than they could actually afford. And that was a domino effect. Once the chips started to fall, the house of cards just fell altogether. But guys, as you can see here, from an equity position, they didn't have much room if things did go sour, where I almost can guarantee if we had that same situation today, we're in a much better position with lots more equity on the table, giving us some options to sell, refinance, etc. All right, and a quick plug, if you do have a large portion of home equity and you're interested in learning about how you might be able to leverage that, check out the book I wrote last year called Unlocking Millions, the ultimate guide to using and investing with the HELOC, the home equity line of credit, and learn everything I know about HELOCs and how I've invested and built my rental portfolio with HELOCs in that book, available on Amazon. Also put the link in the description below. And lastly, if you still are on the fence, if buying is right for you, just take a look at this chart here showing most of America's net worth is tied up in home equity because we see it continue to rise over time. So you buy at today's price, when it does rise, the difference between what you bought it for or what you owe on the home versus where you're at today is going to be in boost or an enhancement to your overall net worth, and just a comparison to the average net worth of that of a homeowner versus that of a renter. You may feel that I'm biased, but I'm ultimately putting my money where my mouth is and buying myself. But what do they always say? The Chinese proverb, the best time to plant a tree was 20 years ago. The second best time is now. You might have wished you would have bought in 2008. You might have wished you would have bought in 2020. Guys, but you can't go back in time and do that. But ultimately, are you going to continue to sit on the sidelines forever, wait for rates to go down, wait for the right president to come in, for housing market to go down? You could build a list of excuses forever. But ultimately, you have to decide what's right for you, your family, and your personal situation. But guys, if you got any value out of this, drop a like, subscribe, or share with someone else who may be sitting on the sideline and need a little push to stop paying 100% interest on your rent. That's what rent is when you go out and pay that. You don't get any principal pay down on that position. And lastly, guys, another huge shout out to my buddy Ryan Kiefer and Kris Brown. Again, their info will be down below. Check out FCM Mortgage on your next purchase. And guys, I promise they'll hook you up. They're almost registered in every state, but check out the site down below for specific states, or just ask them a question. They'll be glad to help you out. But as always, I appreciate your time, your support, and tuning into the channel. I'm Tyler Wayrung, and we'll catch you next time.